Hi friends, Namaste. Welcome all of you to my channel. We all know that investing our money in the long-term project is risky and costly as well. So we have to take some informed decisions based on the evaluation of the capital project. In my last video number 20, I discussed about the how we estimate the project cash flow and evaluate the capital project. Mainly we have two approaches. One is called the discounted approach and the next one is called non-discounted technique, like your payback period. Under discounted, NPV, IRR, net present value, internal rate of return, modified internal rate of return. These are the technique that could be used while evaluate the capital project. We all know that. Now today I will be discussing about the once we estimate or project the cash flow, how we find the NPV, IRR and modified internal rate of return by using the Excel function. Okay, let's discuss the question first. We have a given information like this, like your cost of capital is 15%, while reinvestment rate we assume that is the same as the cost of capital 15%, and our initial investment, which is time period 0, because we always made investment for future today. That is why we say the 2,78,000 is our NCO, net cash outlay, and it is expected that each year 75,700 it generates the cash flow, while at the end of the year it generates the 1,53,700. Okay. Now how we find the NPV? NPV is nothing here, that is your present value of benefits minus present value of the initial investment. In Excel we have a NPV function is there. You just click this one, and rate we say we are using the financing cost or cost of capital. Then at first find the total present value of your future cash flow, then plus your initial investment amount. If you enter it, we came to know that our value is 14,537.93. Again, by using this formula text function in Excel, you just click this one, and once you select your calculated figure, that is the B11, that will provide you the detail what we did here, right? Now how we evaluate this one? When NPV is positive, then we say that the project is good, we accept the project. Now important point is that this is the case of just single cash flow, but in real life we might have a different cash flow. If the projects are, let's say, the mutually exclusive, then we would select the project with the highest NPV. While if the projects are independent, like your, let's see, that is your cash flow of a brick industry and cash flow of the bank, these two projects are the difference, then we would select the project with the positive NPV. That is the criteria. Now what about the internal rate of returns? IRR is the rate of return where NPV is 0. That is the key point that you need to understand here. In Excel we quite easily we calculate IRR, internal rate of return. You just select all cash flow including your initial year, your initial investment. Select all cash flow, that is a B5 to B10, and then just enter it. Then we see that our internal rate of return is 17%. Similarly, what we did here, just you say formula, then you say just select this one, you just select what we did here, B12, you enter it. That is IRR is the just function of B5 to, we select all cash flow. Now how we evaluate the project? We simply, this rate need to be compared with the cost of capital. Since again IRR is greater than cost of capital, we say that if project is financially viable, we accept the project. Now what about the modified internal rate of returns? It is the rate of return. How can we find it? Present value of initial investment equals to present value of the terminal value, and we find the MIRR and then we compare with the cost of capital. Okay. Now what about the MIRR? Okay, you just select this one, MIRR. Now look at the value first. Value is the all cash flow. Then rate is our financing cost, that is your cost of capital, and the reinvestment rate. You have to be careful while using your value, because your modified internal rate of returns assumes that positive cash flows are reinvested at the cost of capital, and initial investment or the net cash outflow are financed with our financing cost. Okay. Now again, you say that MIRR is 16%, which is higher than cost of capital. Again, based on this MIRR approach, we also say that this project is good. We accept the project. Okay. Now manually, when you are asked to find the IRR, then we say our foundation principle is this one: present value of cash inflow equals to present value of initial investment. Then we use this equation, that is the method of interpretations: lower rate plus NPV lower rate divided by NPV lower rate minus the NPV higher rate and the lower rate. Mainly we need to discount our future cash flow. One value we need positive, next value we need the negative. Then you could interpolate your figure to find the IRR. Okay. Now what about the MIRR manually? When you are asked to do so, then you say at first find the present value of your cost of investment, then find the present value of the terminal value. Terminal value is the cash inflow. 1 plus K is the cost of capital whole to the power n minus T. For each year you could find it, like for 0, 5 minus 0, 1 is, for 1 is say 5 minus 1. This way you could find it. Now finally, present value of the cost equals to terminal value divided by 1 plus MIRR power n. N is the 5. Okay. If you solve, then you could find the MIRR. Okay, these are the content that I discussed today. By using the Excel, we could easily calculate NPV, IRR, MIRR, and we evaluate our capital project, and we take our informed decisions that would enhance the value of the company. These are the content that I would like to share today. If you like this content, please like, subscribe, and provide your feedback. Thank you all of you for watching this video. Take care. Thank you.